it's one thing to build a product. It's another thing to understand where the market's going to go and build a product that's going to be suited for the future. And we believe fundamentally that having a debt type product in this kind of market, specifically in our asset class, was poised before the beginning to take advantage of if the market pulls back, if there is a recession, if there is volatility, that in fact our business is anti-fragile. It actually gets stronger and better as a recession kind of evolves, and that's been our original thesis. Talk to us about and I really like, Brad, what you talked about. It's not necessarily predicting the future, but being ready for it. We do a lot of simulation optimization modeling, or what is the band of different types of outcomes that could happen based on policy or different changes in the macro and microeconomic environments, and then making sure how the resilience of those product strategies internally are going to perform in different types of market scenarios. So we're always prepared. Do we take a little bit less risk? Do we take a little bit more risk, depending on how we expect the future to be? So with liquid strategies, and in some ways you guys being our parent as a subset investment, how do you guys look at your strategies and funds relative to expectation of where the future is going to be?
When we build the products, right, Brad talked about the structural alpha and the way they're structured. And really, we look at systematic approaches, right? And at systematic approaches that can generate alpha. So largely systematic investing with a little bit of art on the edges to help and enhance the performance of those products. So with that, there really isn't a whole lot that we do in a large way to try to predict performance. Brad demonstrated tremendous leadership within our organization to help drive the interval fund products, the alternative products and strategies to market at a time where we're just seeing the liftoff, right? So we've got a head start on a couple of these strategies, and we'd love to see them get further penetration to different parts of the market, to 401k plans, to the average investor. Currently, they're only available to larger platforms, to registered investment advisors, other wealth managers like a Bison Wealth. And so I think that we'd love to see the trend toward more democratization, more penetration into the average smaller investor, because both of our strategies are available to non-accredited investors, and they're beneficial to the long term of their portfolio because of the way they're managed and the way that they take advantage of the market. You talked earlier, and so did you, in what we look for in our investments. We look behind the corners. We look in what's not seen. We try to look in underserved and more inefficient markets of private lending, of niche lending. We like to call it niche and alternative because we don't want to confuse it with the big term of private credit or direct lending, because everybody thinks of the large companies in the marketplace and all the money that's coming in, and the big names, right? And how crowded it's getting. That's almost become an efficient market because there's a lot of money coming in, a lot of lenders there, and a shrinking number of borrowers, or the borrowers aren't increasing, right? We like to find situations that are exactly the opposite, right? Where there's fewer lenders and more borrowers, which actually gives us the unique ability to find deals, to find lending strategies and opportunities and managers that are trafficking in areas where you can get better returns with less risk. How do you do where that you find it by finding where capital is scarce,